Gold, I don't think has too much legs to offer at the current level. Silver from here may even move up. US is not in a great shape at this point in time that you and I talk. The more of the yen infusion happens in the market, the yen will not appreciate but rather depreciate.
In US, CPI is cooler than expected. Past employment numbers were also actually revised down by 33,000. These are kind of a recession warning signals. So what is your take on this?
Trump is doing whatever he's doing, and he's absolutely correct in what he's doing from the US standpoint.
They're also talking about this 17 trillion yen injection. Will that lead to a weaker yen? Like, what is the situation right there?
Basic economics will answer the question that the audience really wants to understand.
Will RBI cut rates soon to stimulate growth?
I don't think RBI has a lot of legs remaining for them to be able to cut more rates.
For today's episode, we have got a guest who is a certified financial planner. He is a serial entrepreneur. He has founded Truvanta Wealth, which manages more than 2,500 crore worth of assets. He uses the data sets and analysis that he gives is pretty much astonishing for me as well. So please let me welcome today's guest, Mr. Kirttan Shah.
Ron, thank you so much for having me on the show.
There are so many things that I can't put in one question. There are so many designations. You have started so many things. You've got so many awards. But I want to know, how did it all start? Like, what is your experience in this? How did you get into finance? Just tell me your story.
So Ronit, while I run two businesses, one is on the education side and another is on the wealth side. But I hope whatever I'm going to say next only inspires and motivates more people to do what I've been able to do. Because till the 10th standard, I was very great at academics. So I cleared my 10th standard in 1999-2000, right? And at that time, I scored upwards of 80%, which was great during those times. Today, I'm sure when you tell people that in the 10th you scored 80, I mean, you're just one in thousands, right? Yes. But it was a very different story back then in 1999-2000. Yeah. So I took up science and I took up something called as vocational science, which was again a big thing then, because the dot-com bubble was brewing and everybody wanted to be in IT. So what I got was, except Hindi and biology, I would get computer science, which would only be given to the best or the creamiest of the students. But to my surprise, I was actually passed with grace marks in computer science. Okay. And the college, I'm assuming, did so to save their nose and reputation. Otherwise, I actually failed.
Oh, okay.
Moving on, थोड़ा सा इधर उधर जैक लगाकर I got through an engineering college, and I actually this time was not very lucky enough, and I failed my first year of engineering. So I got 4 KTs out of 5 subjects in the first year of engineering. That's when I probably understood that engineering is not something that really entices me.
Sorry, I'm cutting you off, but from what you've told me till I don't know till which year, there is no finance till now.
There is absolutely no finance till now. What I moved to is also not finance, right? So I moved to BSc Math for my graduation after my failed engineering effort. But I was always very competitive in life. And I had realized by then that, my peers or my friends who I always was neck on so far, they've actually moved ahead, and I'm kind of slightly behind in life. So I started working for a call center along with my graduation. And that's where I got introduced to the world of finance, because the KPO or the call center that I ended up joining, we were working for somebody called Wells Fargo. It's a bank back in the US. And we used to do something called as refinancing. Refinancing means you already have a mortgage or a loan at, let's say, 6%, I would call you and tell you I'm calling you from this ABC bank and I will give you a loan at 5%. So that you can pay off your existing loan at 6% and then your loan becomes at 5%. That's where I got introduced to the world of finance. It was pretty interesting and I started liking it. So what I did was, along with my graduation, I started studying about finance. So I did this program called CFP, Certified Financial Planner. And that was my entry to the world of finance. And then everything else is history. I did pretty well in the world of finance. In fact, before I started on my own, I was heading treasury for a non-banking finance company listed on the Bombay Stock Exchange.
Okay.
But
Sorry, you were working in treasury, you were saying.
Yeah.
So what is it exactly?
so so what happens is when you give 100 rupees to the bank,
Yes.
right? Let's say the bank borrowed this from you under savings account, current account, fixed deposit, recurring deposit, whatever else.
Yeah.
Let's say the bank borrowed this from you at, let's say, 6%. Now, how does the bank make money? The bank makes money when the bank lends this to somebody else at 8%. But there are a lot of RBI rules. But cutting the long story short, if I as a bank have borrowed 100 rupees from the market, I cannot lend more than 65-70% of it.
So is 30-35% have to go to the bond market, or?
So there are multiple regulations because of which I'm not allowed to lend. Because assume if I lend 100% of my money and then there is default,
Yeah.
how do I pay back the depositors whom I've raised money from? So RBI has got a very robust, stringent system to make sure that we are not able to lend the entire 100. So long story short, out of 165 is lent. Now the remaining 35 is not lent, but you still have to pay the deposit holders, right? You cannot tell them that I have not been able to give this out as loan to somebody, so I'm not going to give you interest on your deposits. Does not work that way. So one of the jobs of the treasury team is to be able to invest this 30-35 rupees in a way where it is very liquid for the bank. The bank gets it whenever they want it. There is not a lot of risk on this money because it is at the end of the day depositor holders' money. And still, we are able to generate more returns than what the depositor holders are expecting us to pay, right? So
Is it a tough job?
Very tough job, right? Because
Sounds like it.
how do you make sure that your money is liquid? You are still able to give more money or make more money for the bank than the rate at which they've raised it, and at the same time you are not risking that money at all, right? So I was managing close to 2,000 crores worth of investment for the bank, trying to do this. So my last experience or corporate experience was institutional money management before I moved on. But now today I manage two businesses. One is called FPA EduTech, where we coach people to clear global exams like CFP, CFA, ACCA UK, CMA US, CPA US, investment banking and all of that. And another is that you introduced me with. I am the founder and the CEO for this wealth business called Truvanta Wealth, where we have clients that we manage across 25 countries, some 1,200 families that we manage. And we manage close to 2,500 crore worth of assets for them.
Well,
that's a little background.
No, that's perfect. So I used AI for your public conversations as well on your previous public, because it was pretty long as well. I couldn't go through everything. So what AI told me that you follow some particular, investment strategies. Like you split equally between large cap, mid cap, small cap. You say, gold is also very important, looking at the market because it's a hedge against the inflation as well. Then you also say that index investing sometimes is better than active management, because also if you look at hedge funds, the 90% are not able to beat the market. Yeah. What is your personal investment strategy that you can tell to?
So Ronit, what I want the audience through you to understand that whatever I'm going to talk about, which is my investment strategy, you have to understand that this is personal finance, and personal comes first and finance later, right?
Yes.
So whatever I'm saying is not copy pastable, because this is something that I'm comfortable doing. But I'll give you reasons and logics of why what I do is good, right? So let's say if there is anybody who's got 8-10 years of investment horizon, and that individual has the risk-taking capability, then they can actually replicate what I'm doing. So what I do is, if I have 100 rupees to invest, I split that 100 rupees equally across large, mid and small. Because you look at the last 20-25 years of data, you will understand that when you equal weight your investments across large, mid and small, what you are actually going to experience as return is mid cap, but the risk on your portfolio is lower than mid cap. Now that is the problem that everybody in investing is trying to solve, right? Trying to generate higher returns with lower risk.
Yes.
And my data analysis shows me that this is a great way to get mid-cap kind of returns and lower than mid-cap kind of risk.
Yes.
But why do I experience this? I not only experience this because I'm equal weighting across large, mid, small. I experience this because I have added an additional layer over and above this. What is that? What I also do is I equal weight across strategies, which is momentum, growth, and value. Now, what do I mean? When you look at the mutual fund universe today, you can divide the 44, 45 mutual fund companies into following 3 styles of investing. There is one set of mutual funds who follow value style of investing. Let's say ICICI, PPFAS. These guys are value style of investors. Then you have another set of AMCs who follow growth style of investing. Let's say the likes of Axis, Mirai, right? Even Kotak to a certain extent. They follow growth style of investing. And then you have another set of mutual funds who follow momentum style of investing. Let's say Quant, Edelweiss. Now, what happens is that there are market situations where, or market dynamics where they appreciate, or probably look at it this way, that there are in a 10-year time frame, there are going to be 2-3 years where value style of investing will do much better over growth and momentum. Then there are going to be 2-3 years where momentum will do much better than a growth or a value style of investment. So if you have 8-10 years, and if you are not great at understanding or predicting which style will do well, then you follow what I do.
Okay.
You have 8-10 years of investment horizon. If you want a perfectly diversified portfolio, split that across large, mid, small, and split that across value, growth, momentum.
Okay.
At the end of the 10th year, what you will experience is a mid-cap kind of return, but lower than mid-cap kind of risk on your portfolio.
Okay.
And enough and more data crunching at our end helps us believe and makes us more confident that this is a great diversification strategy, provided somebody has the risk appetite and 8-10 years of investment horizon.
Perfect. Coming to the part of economics, something that I'm really interested to talk to you with, because your analysis, again, it's about Japan and everything else. Because I also saw one of your reels, you said there are only 2 ways a recession is possible. One is through US and the second one is through Japan. Yes. So first, talking about Japan, they raised their interest rates to 0.75, which is the highest in 30 years. Now everyone is panicking. Everyone is saying, okay, this is a huge risk for the yen carry trade. It might unwind and everything else. So the first question is, will this disrupt the global financial system? And the second question is, the follow-up question is, if this is the case, why didn't we see a huge sell-off in the latest hike in the interest rate?
So Ronit, I'm not sure if the audience who's watching us, they do even understand what a yen carry trade is. So let me give you a little backdrop to this question so that they understand and appreciate what my answer is going to be. If you go back 2 decades in Japan, there have been situations or economic situations, if I may say so, where the Japanese interest rates were close to 0. There were some instances where Japanese interest rates were negative. What that means is that you could borrow money from the system and the system paid you for borrowing money. Looks very unnatural in the atmosphere or in the environment that you and I stay in. But that is actually how Japan has been for the last 20 years. So look at Japan as a playground where the world borrowed because the interest rates were close to 0. Right? So if you have interest rates in your country at 0.2, 0.3, 0.4, 0.5, right? It only makes sense for somebody who understands is to borrow money from you at 0.3, 0.4 and then invest.
Yeah, somewhere else at higher.
Yeah, so that is what the world did. Most financial institutions globally borrowed money from Japan and then invested it globally elsewhere. Yes. Now, this money could go anywhere, right? This money could go to fixed income. This money could go to equities. This money could go to cryptos in Bitcoins and so on and so forth. And that's what kept happening. But what you've been seeing lately happen is interest rates or yield, like we call it in the professional world, in Japan has started moving up. And because the yield has started moving up, all of these guys who borrowed money
Now they're getting worried.
at close to 0% are now getting scared because they thought that they had to pay 0.5% interest. But now if the yields have gone to 3.5, the problem is now they cannot refinance their loans.
Yes.
So either they will have to shut the loan up, which they so far just carry forwarded, refinance because the loan was rate. Now they cannot refinance because it is at 3.5%, let's say. The other problem is not just the interest rate, but also the value of yen. Because you've borrowed money in yen and you have to repay the money in yen and pay interest in yen, if the yen moves, then that's a big problem. So the problem is when the yen moves up, right, it's a big cost to you. So look at it this way. You borrowed it at 0.5. You will keep paying 0.5. There's no problem to you. But if yen moves up 3%, then the cost to you is 3.5% because you have to pay in yen. Right. So the current problem to the world is, so if you saw between October 24 and March 25 also, right, one of the reasons that the market fell was the yen carry trade. Because the interest rates started going up, the yen started appreciating. So there was roughly, it is estimated that $4 trillion worth of yen carry trade exists in the market, which means that people borrowed $4 trillion worth of money from Japan, invested worldwide. And when the interest rates started moving up and the yen started moving up, those assets were sold and the money came back. Paid back. Now roughly $1.2, $1.3 trillion worth of yen carry trade still exists is what the economists are saying. But this time around what happened is, now to answer your question, that you are correct that interest rates were increased in Japan, highest ever in 30 years, but still the market did not see sell-off. And the reason is because the yen did not appreciate.
Oh, okay.
So if you see, the yen did not actually go up when interest rates went up, and which is why the markets did not see sell-off. Because please understand, when interest rates go up, right, refinancing is a problem, not the existing loan. The existing loan may still continue at the 0.5, 0.6, 0.7. But if they have to refinance, now the refinancing will become difficult. So the problem of refinancing will happen as and when those loans are maturing. But the immediate impact can only happen when the yen becomes stronger. Because your EMIs will become stronger when the yen, or larger when the yen becomes stronger. But when the interest rates went up and the world because was expecting, the yen already had priced that in.
Okay.
And when
sorry, I'm cutting you off. There was a 90% probability that the rate cut
absolutely. So when the interest rates went up, theoretically, you are absolutely correct that the world should have seen a fall because there was still a $1.2, $1.3 trillion worth of yen carry trade existing in the market. But because the yen did not appreciate, it was not really a problem to the market.
Yes. I guess one thing that people need to, like, normally even I sometimes forget is that things like, yields, markets and everything else, they price in something that is already going to happen.
100%.
Like they run on a future basis. They never run on, like, if there is a news which is like already like is expected, they would be like, for an example, the yields in the US, they already started to go down before the interest rates,
cut happened.
But when the interest rate cut happened, it went up.
Correct.
That is a whole different story.
Same case in India. You look at the last 12 months, you will understand that the government bond, the 10-year government bond, which was trading at 7.6, was already down to 6.7, 6.8 before the rate cut actually happened.
Yeah.
And when the rate cut started happening, the yield started going up.
Yeah.
And people were like, now that the interest rates have gone down,
why is it going up?
Why am I not making more money on my bond portfolio?
Yeah.
Right? But it was already priced in.
Yeah.
Right? So
they need to look at the past as well.
So the markets are future looking and not backward looking. So
yes, perfect. Another question is, they're also talking about this 17 trillion yen injection, 110 billion US dollars. will that lead to a weaker yen? Like, what is the situation right there? They're talking about a huge cash injection. Some people, some analysts are very bullish now on Japan. Everyone is like, now there's a cash injection. Everything might, be better. There is liquidity. What do you think about this? Will it make the yen weaker, and will it be better for the yen carry trade, or what is your comment on?
So basic economics will answer the question that the audience really wants to understand. When does your currency become weak? Your currency becomes weak when either there is too much inflation or there is too much liquidity in the market. Like say, for example, if I give you, let's say you are earning 5 lakhs a month, but I suddenly give you 1 crore rupees a month. What you are typically going to do with so much of money is start spending more, and hence inflation will go up, right? And when inflation goes up, the value of your currency drops. Because let's say if you are able to buy this particular phone for 1 lakh of rupee today, and then tomorrow there is inflation and this 1 lakh rupee phone costs you 1.2 lakhs, the same 1 lakh rupee that could have bought you this phone today will not be able to buy you the phone tomorrow. So when there is too much of liquidity in the market, the value of your currency drops.
So is it better for people in the yen carry?
100% better, because the more the yen infusion happens in the market, the yen will not appreciate but rather depreciate. And yen depreciating is good for the yen carry trade, because I just explained to you. If yen goes up 3%, then the cost to them on the loans that they've taken will go up by 3%.
Yes.
Which is exactly what is happening, right? Interest rates went up, but yen did not appreciate. It in fact was stable and went down.
Yeah. But just a question, if there is the interest rate policy is going up, but the monetary policy is loosening up. So why is there this difference?
Japan's biggest problem for all these years have been that they've not had inflation in the country.
Okay.
While you and I sitting out of India think of inflation as a monster, inflation is actually not a monster. And I'll explain to you. I'll explain to you with a very simple example. Suppose if I tell you that you want to invest in the Indian stock market today, how much return should you expect out of India? How do you get that answer? Suppose if I tell you invest in the Indian stock market today for the next 20 years, how much return should you expect out of India?
Above inflation, definitely.
Right? So that the mathematical answer to that question is nominal GDP. What is nominal GDP? Nominal GDP means that India GDP is going to grow at, let's say, 8%, and inflation in India is going to be 6%. So nominal GDP is 8 plus 6, 14%. Okay? Whatever is your nominal GDP is the return that you expect from your stock market. Now, let's say if your GDP is growing at 8%, but your inflation is only growing at 2%, then your nominal GDP is 10%, and hence your equity market return expectation is 10%. So you want inflation, because if there is no inflation, which also means that your country is not growing, your GDP is not growing. Exactly. The problem with Japan for all of these years have been that their inflation was not growing at all. There was no inflation in Japan. And which is why you see Japan had this loose monetary policy for decades together. So what they are now trying to do is increase interest rates, but at the same time make sure that the system does not get disrupted.
With a lot of money coming. So they are trying to balance it out.
Right. So they are injecting money. They are injecting money, but at the same time, injecting money will fuel a lot of liquidity in the market, and they don't want it to disrupt the market, which is why the interest rates is also going up. So it's a more balancing act than anything else, given the current situation that Japan is in.
Okay. So in the US, we have national debt. Coming on to the US part, we've covered Japan. Now, the second possibility, that is US.
Yeah.
Debt, which is a very big topic on Instagram, I guess. So the national debt is at $40 trillion. The fiscal deficit is wide apart, it is very big, and it's going to increase, I feel, given that the interest rates are already near $1 trillion, and major spending coming on social security and Medicare and everything else. So at the same time, the government is trying to offset that fiscal deficit with tariff revenues, but that is increasing the trade tensions. So these people talking on Instagram and everywhere else, the US debt is a time bomb. Is it actually?
It's actually not. I'll explain to you.
Okay.
Look, you cannot look at any debt as silo. A $37-38 trillion debt in itself means nothing. You always look at this data point called the debt to GDP ratio, right? Because when does debt become a problem? Debt becomes a problem when you're not able to service the interest. How are you going to be able to service the interest? You will only be able to service the interest if your GDP is doing well. So you never look at debt as 37 trillion to be a big problem. You look at the debt to equity, the debt to GDP ratio. Now, very honestly, I don't know the exact debt to GDP right now that you and I are talking, but it's not at a very alarming situation in
I
the
guess
US.
Japan is way more than...
Japan is at 220.
Yes. And US is nearly at 110,
120. Yeah.
Yes,
the last that I read was 120.
Yeah.
Right? It's not a very alarming situation. Also, I will tell you what people don't understand is that even if this, let's say 120 becomes 220, like it is in Japan, US will still not be a problem because please understand US is, the dollar is the reserve currency. Now, what I mean and what I want the audience to really understand is that since 2008, US has been printing money and pumping more money in the market, right? But still the dollar is not depreciating. Why? Because normal economics funda tells you that, I just explained to you, right?
Yes.
That the more the liquidity you pump in the market, your currency should depreciate, but the dollar does not.
Because it is the reserve
It's the reserve currency. What is the reserve currency? Reserve currency means that the global trade is happening in dollars. So please understand, even if this debt goes up, it's unlike Zimbabwe, where US is going to have maddening inflation, or you will need $1 trillion worth of Zimbabwe currency to be able to buy a loaf of bread.
Yeah.
Because these guys are reserve currency.
Yeah.
So till the time they are reserve currency, all of these things are only theoretical in nature. They can print as much money as they want. It will not even depreciate their currency, right? And they'll be able to service their debt as much as they want, right? So the debt can keep going up, does not matter. But the current problem that the world is now trying to challenge the US on is the de-dollarization. So since the Ukraine-Russia war happened and the US sanctioned Russia and they said that, the $426 billion worth of treasury investment or assets that Russia had in the US dollars or the US treasury, they said that we will not give you back. And the euro reaffirmed this 2 weeks back, is where the world wants to move away from a dollar. Because the world has suddenly started realizing that this is too much of power in the hands of the US, because to maintain forex reserves, everybody is invested globally in the US treasuries. And then the US can any point in time come back to you and say, okay,
I'm seizing all your assets.
Yeah, I'm not going to give this money back to you. Then you're giving too much of money or too much of strength to the US at the end of the day. And which is why, you saw the gold rally, because all the central banks have started buying gold because they are not sure of which way or which currency will become the next reserve currency. But of course, for the fact, they don't want more dependence on the dollar, and hence everybody is piling on to gold, and gold has actually gone up. So is the US debt a problem? No. Is the US GDP to debt a problem? No. What is a problem then? De-dollarization. How soon will the dollar become insignificant? I don't have the answer to that question. But has the world realized that they need to move away from the dollar? Definitely the answer is a yes. So whenever this de-dollarization really becomes a major thing is when the US debt will then start biting them.
Yep.
Biting them, yes.
I mean, I used to be one of those influencers who used to be like, oh, debt, the US debt is going to bring the next recession or something like that. Because I didn't have a lot of knowledge around that space. So coming to the next point in US, the data sets which are coming. CPI is cooler than expected. Although the latest data was a bit patchy due to the shutdown, the the job additions beat the expectations, but still the unemployment rate ticked up to 4-year high. Why? Because there were more additions and everything else. So past employment numbers were also actually revised down by 33,000. These are kind of a recession, warning signals and everything else. But when I talk to people and my previous guests as well, there is a division between the analysts and people where one say that we are very much near a recession, and the second one says, oh wait, there is a lot of liquidity which might hit the market, like India, US, and Japan. So this liquidity will actually further delay the upcoming so-called recession bigger than 2008 and everything else. So what is your take on this? Which side are you on actually? Like, or
So
is there a gray space?
So I will give you a very interesting analogy for your audience to understand.
Okay.
Or what is happening in the US. US is not in a great shape at this point in time that you and I talk, right? And which is why Trump is doing whatever he's doing, and he's absolutely correct in what he's doing from the US standpoint.
Yes, definitely.
Right? But what is the problem in the US? The US stock market are probably at lifetime high. Why? You break the data down, you will understand that it is only the top 10 stocks, and they are all tech stocks, which have driven 75-80% of the stock market rally that the US has seen over the last 2 years. So if you measure the US by its stock market, it is at lifetime high. But if you break it down slightly more, you understand it's only tech and nothing else. Right? Now, what you have to understand is there is enough and more evidence and data to look back on to understand that till the time the tech rally continues in the US, you will not be able to see the recession, or it is shadowing over the recession in the US.
Okay.
Now, what is fueling the tech rally? Of course, the way AI is moving globally, it probably is the thing of the future, right? But the kind of money that is getting poured in to the AI business at this point in time is what is shadowing the recession in the US. I will tell you what I exactly mean. If you break down the numbers to understand, recession can only happen when the flow of liquidity stops. It is like saying that only when things go wrong, you understand how many of us are swimming naked.
Yes.
It is very similar to understand only when the liquidity stops is when you will understand what the problem is. And the liquidity here is capex. It's not the stock market liquidity. Today, if you see that the government is spending so much of money in terms of capex, and the corporates are spending so much of money in terms of capex, right? Till the time the government and the private sector keeps spending this money and keeps doing capex, right? You will never understand what is wrong beneath. You will only understand what is wrong beneath the day this capex stops. And I don't see a reason why the capex stops till the time Trump is around.
Yeah.
Because if you analyze what Trump has done in the last presidency also, is exactly the same thing.
Yes.
And he continues to do that. What he does is good for America and is great for America. But the day Trump moves out of office and somebody new comes in and puts a brake on the capex, and I'm hoping that by the time the private sector would have also realized that the kind of monies that they've pumped in the AI business is going to take time for them to yield returns and ROI, and it's no new time for them to pump more money, is where things will start going wrong in the US. But I don't see a reason why things will go wrong in the US in the next 1 or 2 years. Till the time the current president is around and the capex from the government and the private sector continues.
Okay. I saw this thing like when Trump came to office, and even before that, he was saying Jerome Powell is doing a very bad job. He said he should bring rates to zero just so it is easy for them to pay the interest as well. Like it will bring the yields down. and he wants a lot of liquidity in the market as well. Like they have slowly and steadily, like, now they've admitted, like, quantitative easing. Even before that, I feel they were giving reliefs to
Yeah.
regional banks in
Yeah.
US.
Now I'll
But-
give you, I'll tell you, when India comes out with inflation numbers or GDP numbers, there is always this stigma around the numbers that India's issued, saying what is the authenticity of this data that India comes out with.
Yes.
At the time of recording this video, 2 days back, US came out with numbers. US inflation numbers were expected to increase by 0.1%, but it dropped by 0.4%.
Yeah.
And suddenly the next day you see interest rate cut. It is very common. I mean, I don't know if I am able to say what I am able to say,
Okay.
but
No, I get it. I get it. I understand.
But it's
There's we can even question the authenticity of
Exactly.
the US data as well.
exactly
Yeah.
right. When everybody around globally, including their own economists, were expecting that their inflation will move by 0.1, how is it that the inflation moved by 0.4 on the other side, which is big? It's not a small movement, right? Because unless such kind of numbers came out, there was no logic for the Fed to cut rates.
Yes.
Fed cutting rates only became more prominent because the CPI numbers came out to be
Cooler.
Yeah. So this is how it works. Yeah. So
We can, like, basically you're trying to say
Yeah.
the numbers, the data of US might not be, like,
I'm saying
reliable.
it's pretty strange with the way that the numbers exactly came the way they wanted, so that the rate cut could look
Could
natural.
happen. Okay. Basically, if you don't mind me, adding this to the podcast, my previous guest, I was talking to them. He said two things. First, the inflation number is wrong because tariffs are there.
Yeah.
It is completely false.
Correct.
Second thing, we are already in a, like, unannounced recession kind of period where inflation is, like, if you look at US and UK, the inflation is already ticking up.
Yeah.
If you go to a basic grocery store, if you look at basic prices, they've ticked up by more than 10% during a time period, but the inflation says 3 or 4%.
Yeah.
So it doesn't make sense. The employment market is, like, the job market is pretty bad, but the data are not showing anything like
Correct.
that. So he said that, yeah, we are actually in a recession, but the governments are trying to hide the fact, because if they do it, everyone will panic.
Correct.
Okay. So you believe that as well?
100%.
Okay. Perfect. So coming on to the Indian market, as an investor right now, Indian stock market is barely giving any returns. If you look at the factors like, dollar increasing, the rupee depreciating, the dollar increasing, it's because RBI is like, okay, the exports are crushing down like anything, and they've stepped back.
Yeah.
They're not doing anything. Now they're selling a bit of dollars in the market. But the thing is, they're like, okay, we want our exports to be back up. And we are kind of facing that situation there. But on the other hand, because of this same reason, the FIIs are going like, okay, Nifty is barely giving me any returns. Plus, the rupee is depreciating as well. So that is like a double hit for FIIs. And that is why they're continuously, moving out of the market, selling their stocks, selling their securities. And they have more than $700 billion worth of securities in the market. Two questions here. The first question is, the retail investor here is stuck.
Yeah.
He's confused. He doesn't care, like, what dollar and rupee equation have to do with the Indian stock market.
I think it's a very interesting question, Ronit. And the reason I say this is because a lot of people that I lately meet are slightly unhappy that markets have not done anything for the last 18 months.
Yeah.
Right. And I keep telling them, and I've learned this famously from Ashish, who I very respect for his views. Ashish is the CEO for White Oak Capital.
Okay.
And he very famously says volatility in the market is the feature of the market and not the bug of the market. Right? If you're going to invest in the market, live with it. This is the reality. So if you look at the last 18 months, MSCI emerging markets have generated some 30%, NASDAQ is up 20%, and Nifty has done nothing.
Yes.
What that does is gives you a lot of room for the coming 2-3 years. Markets, like we just spoke, don't live in the hindsight, right? They look at the future. So Indian markets, in my opinion, have built a great cushion for them to now outperform the global markets.
Okay.
One. Second, you are absolutely correct when you talk about the rupee dollar equation, because I think under the guidance of the new RBI governor, I think the policy is drastically changed.
Yeah.
I still remember, because I've been tracking this for a long time. At every 1 rupee, right, you would see RBI come in the forex market and try and support the rupee. But I've been noticing since the new RBI governors come in, except for once, which happened the last week, right? There is absolutely no interaction by the RBI in the FX market to stop the rupee fall at all. It is only when it hit 91, I think, I'm assuming the market chatter is that they sold some dollars, which is why the rupee came back to 89.50.
Yeah.
Right? But this is the first time that I see, under the guidance of the new RBI governor, that RBI has done something to protect the rupee, which is very good, because at the end of the day, you really want the currency to be determined by the market forces and not by pseudo regulation of sorts, right? Because ultimately, if you want to attract larger capital from the global markets, you will have to allow the rupee to be more free float than trying to control it. Now, but is that impacting the markets? Yes, it is impacting the markets, because like you rightly pointed out, the FIIs are selling. But I'll give you a very interesting stat. You look at the last 5 years, our foreign institutional investors have sold in the secondary markets only equity 4 lakh crore worth of stocks.
I guess in last 5 years, right?
In the last 5 years.
I guess there are more than that.
Secondary market, only equity. So I'm not talking about primary market, and I'm not talking about fixed income market. Right?
My bad.
Only secondary market, only equity, 4 lakh crore worth of selling in the last 5 years. In 2001, they had 1.3 lakh crore of buying also. Adjusting that, they have net sold some 4 lakh crore of equity. And the market is still 100% up in the last 4 odd years or 5 odd years, right? India is now not what it used to be in 2008. In 2008, when the Lehman Brothers crisis happened, there was no direct relationship to the Indian markets, right? Yes. Our banks were also not involved in the Lehman Brothers crisis. Yeah. But you saw Kotak Mahindra Bank, if I'm not wrong, fell more than 85%. You saw Indian stock markets fall 67% at the index level. Yeah. And I was only 2-3 years old in the market at that time, and I spoke to my seniors then as to what is happening. Why are the markets down 67%, right? Yeah. And the most common answer given to me then was that FIIs have sold $4 billion worth of equity, which is why our markets are down. 4 billion, the rupee at that time was 45. 4 billion is 16,000 to 20,000 crore.
Is that a lot?
That's exactly what I'm telling you. So in 2008, when they sold 16,000, 20,000 crore, our markets fell 67%. Today, the monthly SIP number that comes into the market is 30,000 crore every month. The point that I'm trying to make here is that we'll have to start giving India the liquidity premium that it deserves now. So while the rupee depreciates, 100% a yes, but the second order derivative of rupee depreciating, which is the FII going away, is not affecting the Indian markets like it has done in the past, like in 2008. Yeah. The domestic liquidity is so strong that we are able to absorb the selling that the FIIs have. Of course, we could have done much better if the FIIs didn't sell. But the point in case is that the domestic liquidity is extremely, extremely strong. Yeah. And imagine less than 10% of India is invested today.
Yes.
If we go by the global
3-4% maybe.
Yeah, if we go by the global standard of 47-48% of the currency of the population getting invested, like in the US and China and all, then imagine the kind of liquidity that will come to the capital markets and what will it do to the capital markets. So for the retail investors, please understand, market volatility is, like I said, a feature and not a bug. Yeah. You cannot predict what is going to happen in the near term. But does the long term look good? I don't see a reason why it does not. So, so if you're not a trader or a very professional investor, right, the only saving grace, or I would say the trump card that you have, is to stay invested for a very long time, because ultimately the volatility then flattens out. You look at a 40-year curve, you will see that the market looks like it is going up always.
Yeah. It won't be like this.
Yeah, but you look at a 1-year chart and you will understand that it is like this.
Yeah.
So all you have to do as a retail investor is zoom out and not try and zoom in.
Now, my second question was actually, is if the retail investors can't, like you're saying, it has given in 18 months, Nifty has barely given any returns. What would you suggest from your like analysis and everything else? What would you suggest? Would you suggest any other index to retail investors as of this point, or investing in gold and silver, or any alternate investment platform or anything like this? Just a normal question, if you can provide.
So I will look this. I want the audience to understand that this is not an investment advice, and I'm not trying to tell them that this is what they should do as investment. But I can tell you what we are looking at doing for our clients and what we think will do well in the coming 12-18 months. We are extremely bullish on the IT space at this point in time that you and I talk. We are bullish on pharma, we are bullish on banking, and we are bullish on chemicals. I think these are 4 sectors. So while broadly we are bullish on India versus emerging and developed countries at this point in time, because like I just explained to you, I think India's got a great cushion that it has built with respect to time correction over the last 18 months versus the rally that the world saw. So I think India is now probably at a very interesting level where I think from here on, the risk reward is in favor of investing in India versus investing globally. But within India, I would prefer to have a larger allocation to IT, pharma, chemicals, and banking, because we think that from a valuation standpoint, again, the risk reward ratio is far more favorable to these sectors versus others. Specifically to do with IT, I think I am playing IT as a very interesting anti-AI theme. I think AI is done or probably overdone, in my opinion, in terms of a rally in the US. A lot of capex that has gone in is largely circular in nature.
Yes.
Right, where probably an NVIDIA is investing in OpenAI and OpenAI is again buying chips from NVIDIA. It's all 100 rupees being shown as 300 rupees, whereas it's not actually 300, right? And the Indian IT companies actually saw the fall that it saw was because of the prominence of AI.
Yes.
So I think at the kind of valuations that Indian IT companies are available today, and at the kind of valuations at which IT trades and versus the AI trades and versus the AI theme slightly maturing versus what it was a year back, I think IT in India is a very interesting contra bet. I wouldn't be surprised that the sector turns out to be amongst the best sectors for 2026.
Okay, perfect. What about gold and silver? Any comments on that?
A very difficult call to make at this point in time from a shorter standpoint.
Yeah.
Gold, I don't think has too much legs to offer at the current level. Silver from here may even move up. I was reading a very interesting story lately which said that one EV battery is consuming 1 kilogram of silver.
Yes.
And if there is and if there is 20% adoption of EV only in Europe, it will require silver as much as the annual consumption of silver. So the industrial use of silver has become so prominent that it'll really be stupid of me to be able to make a guess of what silver can do.
Yeah.
Right? So silver I still think has legs, but gold I'm not sure.
Okay.
But people really have to understand that once you enter an asset class, after it has moved so much in the past, right, you are bound to unhappiness more than happiness.
Okay.
Right? So come in with that expectation that you are coming probably at the very fag end of the rally, and you might also get stuck. So professional investors should come in at this point in time if they understand. Existing investors can hold if they are holding. Should you invest more money? I would rather suggest no.
Okay, perfect. Now, coming on to just one more thing I guess I should add on is there is already a very big deficit of silver, I guess, running in the market. If
Yes.
I'm not wrong.
Yes, there is. Because what is happening is the demand for silver has gone up multifold because the industrial use have gone up. But at the same time, you've had retail people like you and me also creating demand in the secondary market, which is also increasing demand for silver in general.
Yes.
So what is happening is if people like you and me buy a silver ETF, right? Those guys are expected to have physical silver made available at the back.
Yeah.
So even when you and I increase the demand for silver in the secondary market, it increases the physical demand at the back end.
Yeah.
Plus, you've seen central government like Russia, China, Saudi Arabia. All of these guys have also started
Buying silver.
in their forex reserves.
Yeah.
So
I guess, sorry, I'm cutting off. I guess they started this year itself.
Yeah. So there are too many legs playing out in favor of silver, right?
Yeah.
And today that you and I talk, if I'm not wrong, silver is close to $67.
Is exactly at 67.
I would not be surprised if it hits 78, 80. But like I said, it is for professional investors to be able to play the last leg of the rally.
Yeah.
Because typically what happens is if you try and play the last 20% of the rally, the probability that you will lose money is far more than making that 20%.
Yeah.
So you should leave it to professional investors to do it.
Okay, perfect. So coming towards kind of a rapid fire segment, I should say. So the first question is is Nifty at current levels at a discount, fairly valued or
fairly valued?
Okay, got it. Should are Indian bank stocks a buying opportunity given their balance sheets?
100% a buying opportunity.
Perfect. Will IT companies benefit from rupee depreciation? I guess
they definitely would, but I think they have far better opportunities. Like I said, because of the current valuations that they trade at, we are bullish for IT for 26.
Even irrespective of
where the rupee moves.
Perfect. Will RBI cut rates soon to stimulate growth or stay hawkish to defend the rupee?
I think this is a tricky question, but I don't think...
No, you can explain if you want. You don't need to give a one-word
I don't
answer.
think RBI has a lot of legs remaining for them to be able to cut more rates from here on. I think we are very close to bottoming of the rate cycle in India. Probably another 25 bips from here on a higher side. I don't think they will cut more than that.
Let's just do this. What's one critical question the audience should ask themselves? Like, looking at the podcast about their own portfolios and about their investments.
I think one question that they should really ask themselves is, are they in for a 7-8 year of investment horizon or not? Because if they are not, they are bound to be far more unhappy than being happy because there is going to be a huge expectation mismatch.
Yes.
Versus what they've seen that the markets do and believe versus what the market is going to be able to deliver in the near term.
Yeah, perfect. Thank you so much.
Thank you so much for having me.
Podcast. And hope to see you soon when maybe
Truvanta
Wealth hits 5,000 crores plus maybe.
Thank you so much for your wishes.
Thank you.
Thanks, bro.